Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm your host here at AlgoBot, and today we're studying an expert advisor called Mass Index Bulge Institutional Reversal. This strategy watches a lesser-known volatility gauge, the Mass Index, for a distinctive expansion and contraction pattern that can hint a change in direction is near. By the end of this video, you'll understand how the indicator works, how the entry and exit rules are built, and how a long trade and a short trade might play out on the chart. Remember, this is educational information only and not financial advice. Let's start with the big picture. This expert advisor is designed to run on the US 30 index, sampled on the 1-hour time frame. That gives it a slower, more deliberate rhythm than a fast scalping approach, with each completed candle representing a full hour of market activity. The engine behind the strategy is the Mass Index, a volatility indicator developed to spot moments when a market's trading range widens and then narrows again. The idea is that when the distance between the highs and the lows of recent candles swells up and then settles back down, the market may be preparing to reverse its recent direction. To measure this, the strategy tracks the ratio of a single smoothed average of the high to low range against a double smoothed average of that same range, and it sums that ratio over a window of bars. When that sum climbs above a bulge level and then falls back beneath a trigger level, the strategy treats it as a completed reversal bulge. On its own, though, the bulge does not tell you which way to trade. That decision comes from a separate 50-period trend exponential moving average, or EMA, which acts as the side selector. If price is sitting above that trend line when the bulge completes, the strategy leans into a reversal to the downside. If price is below the trend line, it leans into a reversal to the upside. In other words, it aims to trade against a move that appears to be running out of steam. For risk control, the strategy uses the average true range, or ATR, to size its stop loss, and it sets the take profit as a multiple of that stop distance using a reward-to-risk ratio. This kind of approach is generally of interest to traders who study reversal setups and prefer a rules-based, mechanical framework rather than discretionary decisions. As always, trading involves risk, losses do happen, and nothing here is a promise of any particular outcome. Now let's walk through the exact logic step by step. On every newly closed 1-hour candle, the strategy first measures the range of that bar, which is simply its high minus its low. It feeds that range through a single exponential moving average, and then through a second exponential moving average of the first, using an EMA period of 9 by default. Dividing the first smooth value by the second gives a ratio, and the strategy keeps a running list of those ratios. It then adds up the most recent 25 of them, and that sum is the mass index value for the current bar. Next comes the bulge state machine, and this is the heart of the setup. The strategy compares the mass index against the bulge level, which defaults to 27. The moment the mass index rises above that bulge level, an internal flag is switched on, marking that a bulge has formed. That flag stays on and waits. The actual trigger only happens when the mass index then falls back down below the trigger level, which defaults to 26.5. When both things have happened in order, first a rise above 27, then a drop below 26.5, the strategy consumes the bulge and looks to open a trade. Before it does, it runs 2 safety checks. It confirms there is no position already open under its magic number, so it holds only one trade at a time, and it confirms the current spread is no wider than the maximum allowed points, which defaults to 40. If either check fails, the signal is skipped. Then the strategy decides the direction. It reads the 50-period trend EMA and the closing price of the just completed bar. If the close is above the trend EMA, the recent up move is treated as running out of energy, and the strategy signals a reversal short. If the close is below the trend EMA, the recent down move is treated as exhausted, and it signals a reversal long. For the exits, the strategy reads the average true range with a period of 14. On a short, the stop loss is placed above the entry by the ATR multiplied by 1.8, and the take profit is placed below the entry by that same stop distance multiplied by the reward ratio of 2. On a long, the stop sits below the entry and the target sits above it, using the same math. So the intended reward is roughly twice the risk on each trade. Let's read through the code the way it looks inside MetaEditor. At the top are the input parameters you can adjust in the strategy tester. The EMA period of 9 and the summation period of 25 shape the mass index. The bulge level of 27 and the trigger level of 26.5 define the reversal pattern. The trend EMA of 50 selects the side, while the ATR period of 14, the stop multiplier of 1.8, and the reward ratio of 2 govern the exits. Below the parameters is the bulge state machine. When the mass index, stored in the variable MI, rises above the bulge level, the G_bulge flag is set to true. The trigger then becomes true only when that flag is set and the mass index has fallen back below the trigger level. If there's no trigger, the function simply returns. Otherwise, the bulge is consumed. Now look at the two signal blocks. The strategy reads the closing price of the completed bar. In the first block, if that close is above the trend EMA, the up move is treated as fading, so it prepares a short. It sets the stop above the entry using the ATR times the stop multiplier, sets the take profit below the entry using the stop distance times the reward ratio, and calls trade.sell. In the second block, if the close is below the EMA, the down move is treated as fading, so it prepares a long, placing the stop below and the target above, and calls trade.buy. That mirror image is the whole entry engine. Let's bring the logic to life on this illustrative chart. Along the price candles, you can see the blue trend EMA weaving through the middle, and in the panel below, the gold mass index line with two dashed levels, the bulge level at 27 and the trigger level at 26.5. The shaded band above 27 is the reversal bulge zone. Watch how the panel and the price move together. On the first candle, price is drifting lower and the mass index sits calmly in the middle of its range, around 24.5. On the second candle, price drops more sharply, the range of the bar widens, and the mass index climbs to about 26. On the third candle, price pushes to a fresh low, and notice the mass index poking up into the shaded bulge zone, above 27. That is the first half of the pattern. The range has expanded. The internal flag is now armed and waiting. On the very next candle, the fourth one, the mass index rolls back down and slips below the trigger level of 26.5. That completes the reversal bulge. The strategy now checks the trend filter. Price here is sitting below the blue trend EMA, so the fading move is the down move, and the strategy signals a reversal to the upside. That is where the buy entry marker appears, right as the down move looks exhausted. The stop loss is placed below, a distance set by the ATR times 1.8, and the take profit sits above at twice that distance. Now follow the trade. The fifth and sixth candles turn upward and begin to climb, tracing higher closes. The seventh candle continues the advance, and price reaches the take profit marker above, where the long is closed for its target. Notice the reward was planned at roughly 2 times the risk that was set at entry. Now the market sets up the mirror image. On the eighth candle, price stretches higher and the range widens again, driving the mass index back up into the shaded bulge zone above 27. The pattern is arming once more. On the ninth candle, the mass index falls back below the trigger level at 26.5, completing a second reversal bulge. This time, though, price is sitting above the blue trend EMA, so the fading move is the up move, and the strategy signals a reversal to the downside. The sell entry marker appears as the up move stalls, with the stop loss placed above the entry and the take profit set below at twice the stop distance. From there, the 10th and 11th candles roll over and press lower, each closing beneath the last. The 12th candle carries price down to the take profit marker, where the short is closed at its target. Across both trades, the recipe was identical. Wait for the mass index to swell above the bulge level and then contract below the trigger level. Let the trend EMA choose the side, fade the tiring move, and manage the position with an ATR stop and a reward to risk target. This is a simplified illustration of the mechanics, and real markets will not move this cleanly. Some signals will reach their target, and others will reach their stop. It is meant to show how the pieces fit together, not to suggest any particular result. That wraps up our study of the Mass Index Bulge Institutional Reversal Expert Advisor. We looked at how the mass index measures the expansion and contraction of the trading range, how a reversal bulge forms when it rises above the bulge level, and then falls back below the trigger level, and how a 50-period trend EMA decides whether the strategy fades an up move with a short or a down move with a long. We also walked through the ATR stop loss and the reward to risk take profit, and watched both a long and a short example unfold on the chart. Everything here is educational content only, and not financial advice, a recommendation, or a solicitation. If you found this helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like us to break down next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.